Today we're diving into something that's been confusing a lot of investors lately, which is why is it that the Quant rating on SCHD has been dropping constantly? Should we be actually concerned, or is this just noise? Stick around because by the end of this video, you'll have a clear, practical view of what's really happening here, and maybe even a bit of an edge over the average investor who's just been staring at ratings without actually understanding them. So without any further ado, let's get started. First, let's quickly cover the basics. What is even a quant rating? In simple terms, a quant rating is a score created by algorithms, not by human analysts sitting in a room arguing over stocks. It actually pulls in a massive amount of data, things like stock price momentum, earnings revisions, valuation multiples, dividend yields, payout ratios, and more. It crunches all of those numbers and spits out a single rating. Usually goes like strong buy, hold, sell, or strong sell. Think of it like a weather app for stocks. It's not trying to predict the next 5 years. It's trying to tell you if a store might be coming next week. It is fast-moving, reactionary, and based purely on numbers. Now here's something important. Quant ratings are short-term focused. They're not built to recognize things like a company's brand loyalty, management, quality, or the power of dividend compounding over time. They're built to spot fast changes in price momentum and earnings expectations. So if you are a short-term trader, quant ratings can sometimes be helpful. But if you are a long-term investor building wealth for over 5, 10, or 20 years, you have to take them with a little bit of a grain of salt. So why did SCHD, one of the most respected dividend ETFs out there, suddenly get a lower quant rating? There are possibly 3 big reasons. Reason number 1, momentum currently is down. SCHD hasn't been skyrocketing the way tech stocks or AI stocks here have been doing. It's been doing what it always does, slow and steady growth. But in a momentum-driven algorithm, slow and steady looks like a red flag. It's not about whether SCHD is doing its job, it's that when compared to the hype-driven stocks out there, it looks quite boring. And boring gets penalized in a momentum algorithm. Reason number 2, dividend adjustments. SCHD recently rebalanced. It shifted some of its holdings, dropped a few underperformers, and even managed to increase its yield a little bit. But that to a quant system, any sudden changes, even positive ones, look like uncertainty. It flags that as volatility, and volatility pushes ratings lower. It doesn't really think, oh great, SCHD is strengthening itself for the future. It just thinks this is different and it might be risky. Reason number 3, broader market trends. Right now, Wall Street is obsessed with growth stocks. Everyone's chasing Nvidia, Meta, Tesla, AI companies. Meanwhile, value-focused funds like SCHD are quietly doing their thing in the background, not really trying to catch the spotlight. Quant ratings are momentum chasers. They love what's already flying. And if it's not flying, they mark it down. Now, the big question is, should you be worried if you hold SCHD? And here's my honest opinion. If you are a long-term investor, not really. Let me tell you a quick story. Back in 2015, there was a wave of fear around dividend ETFs as well. People panicked because they weren't keeping up with the hot growth names. Quant ratings dropped. News headlines were shouting about underperformance. And guess what? Investors who stuck with their dividend strategies and kept reinvesting their dividends through that boring, unpopular phase, they're the ones who are now sitting on a huge pile of wealth. When you buy a SCHD, you're not betting on the next 6 months. You're betting on the next 10 years. You're betting on the power of compounding, dividend reinvestments, and owning slices of big, profitable companies. Short-term momentum ratings simply don't tell the whole story. They're reading the waves. They're trying to sail across the whole ocean of stocks. Now, here's a smarter way to think about quant ratings if you still want to use them. I treat quant ratings like a little bit of a check light. If a stock or ETF I own suddenly drops to a strong sell, I don't panic right away. I investigate further. I ask myself, is the dividend being cut here? Are the businesses failing inside that ETF? Is the management making poor decisions? Is the balance sheet deteriorating? If the answers are no, if it is just short-term noise or market trends, then I keep calm and stay the course. And right now for SCHD, the fundamentals are still incredibly solid. The companies inside are still generating billions in profits. The dividend continues to grow, and the portfolio adjustments are actually making SCHD even more resilient for the future. So from where I'm sitting, there's no real, doomsday warning here. It's just a little dashboard light blinking because the market's chasing shiny objects right now. So to wrap things up, SCHD's lower quant rating is a short-term reflection of market momentum and not a long-term reflection of quality. The fundamentals are what really matter, and SCHD's fundamentals are still very much intact. Always remember, quant ratings chase what's hot, but true investing success comes from patience, consistency, and letting time and dividends do the heavy lifting. So if you found this video helpful, please make sure to hit that like button and subscribe for more clear, simple investing breakdowns made for everyday investors, not day traders. And until next time, stay patient, stay invested, and stay smart.